Good morning and welcome to Bazaar Morning Call. I am Anuj, with me Sonia and Nigel joining us today. Well, we are in for a rough start, as the screen must be telling you. Look at what's happening globally. There's a big risk of, this is a point we've been making for some time, that the Indian market has been ignoring global risk off, especially emanating out of the money market. For how long can it continue? The bond market route is finally catching up with equities in global market as well. The US 10-year yield overnight saw a big move, 0.16% to 3.353%. Remember, the 3% threshold was broken long back, and we're at 3.35 now on that. And the strong US ISM data is all but confirming. It's pretty much nailing in a 75 basis point rate hike. That is something which the market perhaps now has to deal with. And that's what the dollar index is also telling you, that after retreating multiple times from 110, finally it's crossed that and trading at 110.5. But this morning, if you're looking at positives, it's that the Brent crude has seen a big slide because of that. So that may suit some blow for India. But the SGX Nifty still is indicating that we start 200 point lower, if the SGX Nifty is right, that is, and then take it from there. Sonia, Nigel, hi, morning.
Hi, morning, Anuj. Morning, Nigel. Absolutely. I mean, today is going to be a rough day, right? No two ways about that. I guess in the run-up to the FOMC meeting, which is on the 20th and 21st of September, this caution, this volatility, this uncertainty will continue to be there across most global markets. So that's the overhang. Of course, the 75 basis points rate hike is the base case assumption now for most on the street. So perhaps that's making the markets a bit tentative as well. Not just the US markets, even Asia is under a lot of pressure this morning. So you have the Nikkei, which is down 320 points the last time I checked. So across Asia, there is a risk off. The US 10-year bond yield, as we were just discussing, has hit the highest level since June. Brent crude is also below that $94 a barrel mark on perhaps demand fears there, almost at 91 now on Brent crude. The Nifty outperformance, though, is something that has continued for a while, and we've been holding on to this 20-day moving average of 17,620. The buying from FIIs continues. In fact, yesterday, both FIIs and DIs bought in the cash markets. So some level of confidence is there in this market, Anuj, given the fact that we've been so resilient despite the global fall. But what is the best way to approach this macro cue? You know, there is a big rate hike coming. Risky assets are not in favor. For an Indian investor, how does one approach it?
You respect the screen, Sonia. The market's been outperforming for some reason. So, you never question the market's wisdom. My sense is just in the, just for today, for the first hour, you see if the SGX, if the Nifty futures are respecting the SGX Nifty low. Normally on days like today, SGX Nifty low does not get violated. And, selling after 200-point gap down is not a good risk-reward trade. It may work, but it's not a good risk-reward trade. A good risk-reward trade is actually to see if the market does not fall a lot. And then in that case, if the SGX Nifty low is your stop loss and you buy, and that normally makes sense. Whether that works out or not, we'll find out. And the reason for that is our market has been strong. The price action has been quite strong. We have been ignoring global risk off. Of course, at some point, we will participate in that. It cannot happen that the global market just keep falling and we keep rising. But it can happen that maybe we fall less. Even if we align with global market, we fall less. As you've seen year to date, our market clearly has been a big outperformer. I think the level to watch, and from trading point of view, this level is sacrosanct. I've been making this point for last 3 or 4 days. The 20-day exponential moving average of 17,475. That's been well respected. And in fact, there's a good chance that today you get very close to that. So again, from the risk reward point of view, that will make sense that, you normally, because the market's texture has been buy on dips unless told otherwise. So you try to see if that buy on dip works or not. I mean, today you get a dip. So you try and see if it doesn't work, you get stopped out. It's very clear and very well defined. Only on a close below this 17,475 do we negate the near-term texture of the market. Now, interesting data from FIs. They've been buying in cash market, but they've been hedging a lot in the futures market. In fact, yesterday also they net added about 11,000 shorts, and we are now at 81% short positions once again on the futures. Once again, I ask the same question, if these shorts do not get followed through. Today it looks like they will, but it will be interesting to see the actual open and then after that the move. For the medium term, there are two levels which are well defined, 17,200 and 17,800. Below 17,200, you make a lower low. Above 17,800, you make a higher high. So in that sense, this is the battle. A close below 17,200 or a close above 17,800 decides the next major move. Till then, you will keep getting volatility. You'll have to negotiate in this band. But as I said, the larger impulse of the market is to buy the dip. And that doesn't change unless we close below 17,475. The other issue is that domestic facing stocks, they have been outperforming. You look at capital goods, autos, FMCG, Bank Nifty, most of these indices are in a bull market of their own. It's just the IT index which has sort of kept the Nifty under check. But my sense is that if the market has to recover, once again, it will be on the back of domestic facing stocks. So that's something that I'll keep an eye on. Najal, hi.
Well, hi, morning, guys. The valid point, Anuj, in terms of the broader markets, if you look at the headline index, yes, you'll see the Nifty was up or down 20, 30 points odd, but the real outperformance came from the mid-cap index. The mid-cap index was up close to around 0.5% odd, and there were plenty of stocks that were giving you big returns out there, and some of them have already rallied in the last couple of months or so. But just a quick point on the flows picture. Well, as a headline, it looked pretty good that the FIs as well as the DIs, both of them were buyers. But a little deeper look into that, the FI gross volumes in the past couple of days have been relatively lower in comparison to the last 1 month or so. So participation is not full tilt as of now. So today's FI data will be something that I'll be tracking very closely. On the DI front, remember yesterday you had a large trade. That's a Syngene trade, more than 1,000 crores odd. We had ICICI, well, they were ICICI mutual fund. They bought close to around 15% of that block. So close to around 150 crores odd was likely. That number of around 600 crores DI by number, it includes a larger chunk, I think, of the Syngene flows. Only ICICI mutual fund got captured, but I believe that domestic mutual funds, they participated in a large way in that large trade as well. So the DI flows as well is something that we'll be tracking closely. The FIs, they wrote calls very aggressively yesterday, close to 60,000 contracts odd. The sense you're getting is we'll require a bigger queue, a bigger trigger, a bigger push to get past that 18,000 odd mark, because for the last 1 month or so, we've been going to around that 17,900 to around that 18,000 odd mark. And from there, we've seen some bit of resistance. For starters, we'll be pulling back. But as we mentioned earlier, the 20 DMA is crucial. Maybe risk reward favors buying that, early morning dip. Let's see how things pan out. So, what else?
Absolutely. And there's less than 15 days for the FOMC meeting, right, on this 20th and 21st of September. And in any case, the view now, the narrative now is that money has been moving out of developed markets like Europe and US because of the challenges over there, and perhaps into markets like India. Let's see if that's something that continues to play out. For today particularly, it's looking like it's going to be definitely a tough start. But here's what you'll get to see. On the equities front, first up, we have an opinion coming in from Venugopal Gare of Bernstein, who says that the Indian equity market has now breached the upper end of the range and structural arguments on India have returned. There is still macro uncertainty. Bernstein's recent conversations with most CIOs of domestic funds suggested a cautious stance at these levels. Risks include a sluggish rural economy, return of inflation if global rate actions fail, limited government balance sheet flexibility, and the impact of higher rates. Even as they maintain a core positioning, Bernstein moves to underweight on most consumption end markets, downgrades industrials to an equal weight, and upgrades building products and energy to an overweight.
Okay, let's get you some money market calls as well. Kunal Sudhani of Shinhan Bank says that the higher than expected improvement in US services PMI lifted the dollar index appeal. As the US economic data is displaying a stellar performance, Fed Chair Powell has the luxury to sound hawkish in his speech on Thursday. US 10-year yield continues to move higher, while dollar index may test 111.5 levels. For USD INR, 79.70 is acting as support, while 80.2 is resistance.
All right, and on the bonds today, Neeraj Gambhir of Axis Bank says the market has started the week on a positive note following the fall in global yields post the non-farm payroll data released last week. For the rest of the week, the market will take cues from the upcoming ECB meeting and the Fed Chair Powell's speech later during the week. He expects the 10-year benchmark bond yield to trade in a range of 7.1 to 7.2% for the week.
Well, we have a lot of stock-specific action to discuss as well, and we'll get to that in just a bit. But the top stocks that we're tracking today, we're looking at steel stocks. That's Tata Steel, JSW Steel, JSPL, as well as SAIL. GMM Pfaudler, that's another stock that will be in focus. HAL, Paras Defense, RCF, and NFL. All of them will be on our radar on the back of positive news flow. They could be relative outperformers. While you have Hudson Agro, that stock could open up in the red owing to that promoter sale. All right, well, let's welcome our first guest on the show. We have Cameron Brandt, Director of Research at EPFR Global, who joins us on the show. Hi, Cameron. Thanks so much for joining in. Well, a month or so ago, you had joined us and you were telling us there's definitely more amount of interest for the Indian stock markets. Could you tell us how things have changed in the last 1 month or so? We are calling for a higher share of the total emerging market flows. Do you think that's likely to be the case?
I think that is still the case. Since we last spoke, there have been steady, if not spectacular, flows into dedicated India funds. And India funds have been really second in the emerging markets universe after China in terms of attracting fresh money. And so certainly, I continue to think that that's a likely trend. As I'm sure you're aware, many of the forecasts in the developed world, especially Europe, for the end of the year into next, make somewhat gloomy reading. So a large market with a strong domestic demand story and the promise of 7% growth is very attractive at the moment.
Cameron Hagg, good morning. But, is this being driven by ETFs? Because that can change on a dime, like we saw earlier as well.
Yeah, not completely. There's been a reasonable amount of money coming through the mutual fund channels. I tend to view the numbers in late August with a certain degree of caution. It is, even in these somewhat uncertain times, the summer holiday season here in the Northern Hemisphere. A lot of flows and trading activity is a little thinner than it usually is. But the interest in India has held steady, and the big diversified funds continue to have to find alternatives to their Russian exposure, and India has certainly been capturing some of that money.
But a large chunk of the FI money that has come into India has come via emerging market funds, and within that, India has received a larger share. Do you think that's a trend that can continue, or do you see other markets as a bit more attractive compared to India for the rest of the year?
Depending on how Brazil's election plays out and what emerges from the Chinese Communist Party's Congress at some point in the fourth quarter, those markets could certainly regain some of their luster. But I don't see much competition at the moment from any of what you might call the second-tier markets. And I think until those waypoints in Brazil and China are passed, that India is likely to see pretty steady interest from the gem fund managers.
All right, Cameron, what about, since China is in such a flux, are you seeing, cutting down of exposure to China? Because the next action could be then the flows come to India. Are you witnessing that?
We certainly saw the gem funds fairly aggressively cut their exposure to China towards the end of last year and into this one, though that reduction in exposure has plateaued a little bit. What has been interesting has been the persistence of institutional flows into dedicated China funds, nearly 3 billion last week. So there's clearly a reluctance to sort of give up on the China story, and a feeling that there, especially with this correction, there's now some value in that market.
If you look at the plate on the screen, I don't know if you can see it right now, but there is a weightage as per a country or economy given in most of the large dedicated funds. And Europe and, West Asia is still high at about 8%, but Europe has come down substantially. There are a lot of challenges that we're seeing in the European markets as well, whether it's escalating gas prices, the whole power crisis situation over there. Do you think because of the challenges that we're seeing, not just in Europe, some parts of North America as well, outsized flows could now move into markets like India and China?
I certainly think that people, when they come back in September, are quite likely to make some more aggressive bets. Chairman Powell's promise of pain at the Davos summit has not gone down particularly well with mutual fund investors who have a developed markets focus. On the other hand, so many of the variables that we track and focus on could go in a number of directions that I think it's a little early to say there's going to be a large move to emerging markets, but emerging markets are certainly holding up better than I thought they would earlier this year. The big ones, India, China, and Brazil. Russia's out of play at the moment, but even Korea. I'm certainly seeing interest that is more often than not positive week to week.
Cameron, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. So there's been steady funds inflows into the Indian market, and not just ETF flows, but from the mutual funds as well. Basically, not just the passive funds which chase momentum, but some of the actively managed funds as well have been deploying funds into India. Basically, the long-only money, which holds markets in good stead, and our market has been outperforming. This is one market where, of course, there's clearly some signs of growth as well. I know decoupling is a strong word. Last we heard that was in 2008, and with the lag, Indian market also participated in the decline. But before that, the real decoupling had happened in the 2003-04 phase, which is when our market had really seen a massive outperformance. And a lot of people believe perhaps this could be a similar phase. We'll find out soon enough, of course. We'll take a break. As we do that, let's get you some important opinion that we got on the outlook for emerging markets coming in from Mark Mobius of Mobius Capital Partners.
If you look at the emerging markets index, it's been terrible. It's been underperforming. And the main reason is because of China. It represents 30%. As you know, China is in real trouble. It's probably going to get worse there. But what we do is look at individual stocks in individual countries. So, for example, if you have Indonesia outperforming the U.S., you're going to find some stocks in that market that will do fairly well against the U.S. stocks. So it's time now to be very, very picky in what you want to buy anywhere in the world, wherever you are, including, of course, the U.S. So the indices look bad for emerging markets, but individual countries, in some cases, are going to be okay.
Welcome back to Bazaar Morning Call. This morning, the SGX Nifty is suggesting a sharp cut for our markets. But let's see. We'll take it as it comes. For now, our market has been resilient, at least up until now, holding on to the 20-day moving average. But our research team is here to help us prep for the day. Anuj, what are you looking at today?
So, Sonia, just to reiterate the base case, if the market has a gap down, you look to see the selling exhaustion, especially around that 20-day exponential moving average, 475, if that happens. And if that happens, then I think you back stocks where there's leadership and relative outperformance. So ICICI Bank for sure and State Bank of India. I think these are clearly two names which are now go-to stocks for the market. Every dip, if you sort of buy these stocks, you're making a lot of money. So, in a bull market of their own, both these names. So that's something that I'll keep my eye on. But Nigel, you're watching out for steel companies.
Well, that's right, Anuj. It's always a bit of a risky trade, steel, but there could be relative outperformance. And yesterday, in the final hour of trade, all the steel names, they showed some strength as well. The news that's coming in is ArcelorMittal. They've gone ahead and they've increased prices yet again in the UK region. Remember, in Europe as well, they're already taking a couple of price increases. And now they've pushed through another price increase in UK, topping the August price increase as well. What is the impact of this? Well, European prices could remain elevated. That's in spite of weak demand that we're seeing out there. Capacity shutdowns as well could continue in various pockets of Europe. So if that happens, then inventory buildup is not there. And, then prices could continue to remain elevated. For the Indian companies, well, it could be a bit of an advantage scenario that plays out. Why is that? Because global prices could get some bit of base after seeing a sharp correction in the last 2-3 months odd. The Indian steel mills, remember, the cost of production is a little bit lower because of accessibility to iron ore as well as power costs, not as elevated as what we have seen in Europe. And the third factor is we are getting, news that's coming in from various pockets of Delhi that maybe there could be some relief on that export duty. If that happens, then in fact, volumes as well do see a bit of a relief on that front because they can export without paying that 15% off. So all these factors together could help steel stocks to outperform, though China continues to remain the joker in the pack. If demand doesn't come up there, then globally steel stocks will get hit. But for the time being, going with green for these stocks.
And we were speaking to the management of Shyam Metallics, and they told us that the EBITDA per ton is expected to fall
11,000.
to 11,000, and they see more pressure there. So I guess pricing also under pressure,
Yes.
demand also getting hit. So the challenges still lie for the steel sector on the whole. We'll keep them on our radar. But Hindustan Agro is the other one that we're looking at this morning. Nimesh is here to tell us why. Hi, Nimesh. Good morning.
Hi, morning, Sonia. So, in a disclosure, surprisingly, the promoter entity has sold 1.2% stake in a block deal in Hindustan Agro. Well, the buzz was that maybe a leading boutique firm was a seller yesterday in a block deal, but it turned out to be that the promoter entity has sold 1.2%. Now, the promoter owns close to 56%, so a bit of negative because the promoter entity is sold. In terms of buyers, couple of marquee names, so SBI Mutual Fund and Sundaram were the buyers in yesterday's block deal. But the fact that the promoter has sold 1.2%, a bit of red to start with in Hindustan Agro, just because the promoters have sold, and there is no reason or explanation given as to why they've raised this money by selling 1.5% stake in the company.
Okay, thanks a lot for that. So that's on Hindustan Agro, promoters selling stake. But GMM Pfaudler had an analyst meet yesterday, and my colleague Vahishta attended that meeting. Vahishta, what was the key takeaway?
Hi, Sonia. Yes, that's right. GMM Pfaudler did have an analyst meet yesterday, and they had given FY25 guidance, and this is only from the existing business. It does not incorporate any mergers and acquisitions, which they're planning to, look forward to in future. So for the revenue is expected to grow to 3,700 crores, which means a 14% CAGR from FY22 to FY25. EBITDA is expected to grow to 630 crores, CAGR of 24%. EBITDA margins would jump to 17%, which currently is at approximately 13%. And the return on capital employed will be at 25%. Also, the capex is expected to be at 3% of the revenue. GMM Pfaudler has also said that the pharma sector capex is slower than the chemical sector capex, not just in India, but just also globally. And the company is looking for inorganic growth with the size of acquisitions going up to $20 million.
Okay, so we'll keep an eye out on GMM Pfaudler. In fact, yesterday the stock moved higher on very large volumes. But Vaishta, stay with us. You're tracking defense companies as well. Tell us which ones and why.
Yes, the first on my radar is Hindustan Aeronautics, wherein the company has said that they had produced gas turbines for the INS Vikrant, and these were assembled and tested at the company's facility at Bangalore. And the next stock on my radar is Paras Defense, wherein they have said that they had entered into an exclusive teaming agreement with ELDIS Pardubis, which is a leading manufacturer of active radar systems in Czech Republic. Now, this agreement is to provide turnkey anti-drone systems for civilian airports in India.
Okay, thanks a lot for that. Lots happening in the defense space, and these stocks have been on fire. But let's go across to Sonal. She's tracking the fertilizer companies this morning. Sonal, good morning.
Good morning, Sonia. Well, sources told CNBC Awaaz that some of these PSU fertilizer companies, they are up for divestment, and this has been in works for a long time. So the government said they have identified 8 fertilizer PSUs for strategic divestment. In the listed space, the likes of RCF, we have National Fertilizers, there's FACT. All of them could be up for sale in the coming quarters as well. The other ones from the unlisted space include Hindustan Fertilizer, there's Brahmaputra Valley Fertilizer. However, important to note that this plan has been going on for a while, and the decision is not final yet. So that is something we'll be watching out for. But these stocks will be in focus today.
Okay, thanks a lot for that. Thanks to our entire team actually for putting all of these stocks together. In case you missed out on them, here's a quick recap. Stocks with positive news flow. There's Tata Steel, JSW Steel, JSPL, SAIL, GMM Pfaudler, the defense names HAL, Paras Defense, RCF and NFL from the fertilizer space. While stocks with negative news flow, there's Hindustan Agro on the back of the selling that we've seen by the promoter. All right, well, moving on, Manisha Gupta joins in. There's so much action happening in the commodity universe. Brent crude prices have been under pressure for a while. Manisha, good morning. Welcome back. There's lots that has taken place since you left. But you tell us, what are you tracking this morning?
Oh, well, absolutely, Sonia. Never a dull day when it comes to commodities, and that continues during the day today as well, where you are looking at the U.S. natural gas prices now trading at a 4-week close. $8 per MMBTU has been broken on the weaker side as well. We are looking at the new UK PM now to unveil energy rescue plan on Thursday. So all eyes on that event for this space there. The crude oil prices, well, yes, have extended declines, now trading very close to the lowest since the month of Feb. The OPEC and allies cutting output by 100,000 barrels per day has seen a reaction and has been digested into the market. The concerns clearly are about the a weak Chinese demand and the ECB monetary policy meeting on Thursday, where the markets are anticipating a further rate hike. In the metal space as well, whether it's gold, silver, copper, iron ore, all of these metals have started slightly on a weaker note. The strength in US dollar also continues to weigh onto this space.
Okay, all right. Thanks a lot for Manisha, and good to have you back. Well, let's also listen to what Citi's Ed Morse had to say on crude prices going ahead.
We have a different set of circumstances now weighing on prices, but also risking a higher price. The biggest one is the accelerating global recession. We haven't felt it in the U.S., but we felt the impact, as I said, of prices on demand. We're seeing radically lower demand around the world, and that is where the pressure is coming on prices. As we said, a recession can bring the price down not to the $82 level that we see WTI at the moment by the end of the year, but well under 70 if the recession really hits around the world, and things are moving in that direction.
Okay, that's an update on what's happening in crude, but let's get back to equities now. We'll slip into a short break. On the other side, all of the top stocks will be discussed with the Indian Choksi of KR Choksi Securities. We'll also connect with Jagannathan Chakravarti of Sonata Software to discuss an outlook on their business. Stay tuned.
Welcome back. You've seen the bad news, right? Since morning, the SGX Nifty is down about 200 points, 192, in line with what's happening in Asia and what's happening with the global market. But our market actually has been resilient. It's been facing weak global cues and still outperforming. So could today be the same? We'll find out soon enough, of course. Devan Choksi is now joining us from KR Choksi Securities. Devan, hi, good morning. Thanks a lot for joining us. While the market's been resilient, Devan, one space which is clearly heading back towards its recent lows is IT. I mean, Wipro is already almost there, within 3% of that. Infosys within 6%, TCS within 5% of 52-week lows. What's your view on this sector? Because that's clearly something which has been keeping even the overall market gains in check.
Hi, Anush. Good morning. Well, I think our understanding on the subject is that on one side, the demand scenario remains, I think, extremely convincing and buoyant for most of the IT companies. I think they have not been short of receiving orders as far as, I think, the long-term contracts are concerned. In fact, I think likes of Infosys and TCS have been gathering some of the larger contracts, which has got the visibility of next 5 to 7 years as far as the execution is concerned. So I think they are already there. Some of the mid-tier and the smaller IT companies who are operating their niche environment, I think they are also getting the contracts in the tens of millions of dollars, I think, which is again giving a visibility of next few years. So from a perspective of looking at IT companies, I don't see too much of a problem as far as I think they getting near orders. And largely so because on one side, you are having the world passing through, I think, good amount of turbulence. On the other side, I think the businesses are basically requiring to adopt IT more as a service than as a capital expenditure. So from that perspective, I think our Indian companies are already well positioned, as I see it. The current challenge in the market is twofold, as I believe. One, of course, I think the cost because of the attrition in acquiring the talent, etc. The other part of the challenge that we are seeing in the market is that because of the financial markets challenge, I think most of the IT companies where some of the passive funds would have a higher amount of exposure, they are the ones I think who are offloading the portfolio, and as a result of it, I think the stock prices come down. So on one side where the fundamentals remain, I think, absolutely intact, on the other side, the market technicals are possibly, I think, making this particular stock trade in a range. And that's where I see the opportunity. At the lower end of the range, when I think these stocks are available, if you as an investor or I think even a positional trader, you buy these stocks, probably I think in a year itself, I think you end up getting 15-20% kind of appreciation out of it. So this market remains, I think, largely traded market for at least some of the largely owned stocks in IT space. And that's where I think one could possibly put the rationale that why these stocks are falling in current times. Maybe I think you will soon see the buying happening at lower levels given the strength of the fundamentals.
Devan, hi, good morning. I wanted your thoughts on some of these other big movers, right? Something like an Indian hotels. UBS has come out with a report this morning where they've raised their earnings estimates for the company. At this 300 rupee price, how does the risk reward look for a stock like Indian Hotels?
Sonia, good morning. Well, I think while the demand scenario for the once again occupancy in the hotel rooms has remained absolutely very, very strong. And likes of Indian Hotels, Bazaar, or for that matter ITC, they have, I think, reasonably premium properties available with them, where they are possibly seeing a higher amount of the offtake in this season. Largely also because of the fact that soon, the next quarter, we will be entering into the marriage season. And I think next 2 quarters hereafter would possibly also be asking for that side of the demand coming in. As a result of which, the revenue and the profit scenario remains, I think, pretty strong as far as I think the current financial year is concerned. However, this particular sector remains largely capital-intensive sector, and here I think the asset-light model in some cases have started working. But largely, I think the amount of money which is being spent in maintaining the property, innovating the property, I think that demands good amount of cash, which probably I think like investors who probably always find that I think the companies are working on negative cash flows, and that could be one of the reasons for which I think these stocks move in a sequence. Suppose if now the sequence is that I think the working of the companies are looking stronger, so the stock prices will go up. And moment I think you are into the capex mode, again the prices will go soften. So yes, current scenario suggests that I think the stock prices should remain firm, because I think the demand scenario as well as I think the profit picture is looking, I think, absolutely convincing for the current year.
Okay, all right. Hi, Deven. Morning. I want to ask you about ICICI Lombard. There was a Jefferies note that came in yesterday. They said that in the last 1 year, the stock has been a big underperformer. It's down, in the last 1 year. So, yeah, that's a stark underperformance, 19% underperformance. But they believe that risk reward is now favorable. 2 issues are plaguing the stock. One is the stake sale. Second factor is, the leadership. That's a CEO change in the next couple of years. But they believe both are likely to clear out. Do you think risk reward is now favorable with the stock underperforming for the last 1 year or so?
Yes, Nigel. Good morning. I would think so. I think most of the insurance companies have remained underperformer, because in past, if you notice, I think how they behaved, probably I think they moved much faster compared to their fundamentals following them. And as a result of which, I think the stock prices had to get corrected. If not, I think a price correction, the time correction was required in this particular situation. ICICI Lombard in particular, if I see, I think probably one of the best company as far as I think their ability to design the new products concerned. And that is where probably I feel that I think they would have relatively larger reach to talk about. I think the 2 things which I obviously notice in most of the insurance companies, how soon and how fast I think they digitize their operations, which brings down the cost of producing the product, and at the same time servicing those products, and they go to the market as a first mover advantage. I think in all this category of checklist, I think if I look at ICICI Lombard would probably within the general insurance segment would remain, I think, among the best along with the Bajaj Alliance. So from this perspective, I would think that I think these are some of the companies which could possibly be looked at from buying. I think for 15-20% kind of appreciation in this kind of a stock, I think is distinctly possible going forward. I think when you look at these companies from the current year and the next year perspectives.
Okay, well, Devan, I just want your thoughts on what's happening with Ambuja and ACC. And let's just pull out the chart of Ambuja, for example, the last 3-month chart, way above the open of a price. I mean, there was a time when let's just pull out the chart. There it is, 3 months, 20%. For long, of course, these stocks were trading at a discount to the peers, right? There's this wholesome discount, and now all of a sudden there's this Adani premium, right, on Ambuja and ACC. But at current level, do you buy them? What's your view on both Ambuja and ACC now?
Yeah, no, I think you call it Adani effect, I think, as far as Ambuja ACC is concerned. And definitely, I think the stock prices are quoting it premium. And as you rightly observed, I think in good many months and the years, I think the stock prices have remained underperformer for a long period of time. The important point, I think, which I would like to bring up for cement industry in general, and maybe I think for wholesale, now it is our Adani Group companies. I think there probably on one side, demand scenario is remaining extremely strong. So the companies which having the pan-India presence, for them, according to me, I think the second half would get reflected very well as far as their ability to sell is concerned. The second part which I see here is that I think if earlier quarters they were affected by the higher amount of cost and I think the input cost, probably in this quarter in the next year after, I think the costs are going to remain slightly benign, and as a result of which, I think the margins are going to be protected. A case in favor of Adani Group, I think, as far as I think the cement business is concerned, which is largely logistic oriented, they have a fantastic connectivity through ports, I think, which they operate their cargoes. And as a result of which, I think the shipment of cement, which Ambuja has always been demonstrating well, I think would possibly be seen, I think, much more effective. And as a result, with the logistic cost would be under control. Should you control logistic cost, and I think you have a stronger demand scenario, the equation works in your favor. Of course, I'm not at this point of time, I think, giving the discussion on the merits of the premium that the stocks are commanding. But I would generally believe that I think along with Ultratech, along with I think Shri Cement, these Adani Group stocks, I think they remain relatively more stronger from the investment perspective.
Okay, thanks a lot for that. Well, just stay on. We are going to shift gears away from this sector to the IT space and would request you to listen into the conversation that we're having next. The Sonata software stock is on our radar. It has slipped 30% from its 52-week high. It has an exposure to Europe, so perhaps some demand pressures there. Has attrition eased, or are things picking up? We are joined by Jagannathan Chakravarti, the CFO at Sonata Software. Mr. Chakravarti, thanks a lot for joining in. Welcome to CNBC TV18. First, I want to ask you about any signs of a slowdown in Europe. Over 20% of your revenues comes from there, and Europe is going through a challenging period right now. What are the demand trends looking like?
Yeah, particularly in Europe, UK, we are more based on UK. We have not seen that much of slowdown in the ground. That slowdown, in my view, reflects in your contract cancellations or contract deferments or rate renegotiation, discounts requests. All these things are what we see in the ground. Not much is happening on those. It looks no negative news as such coming out of the market now. Overall, also, the US market and the Europe market together, the ground level, it doesn't reflect the kind of what it is coming out. However, there are other challenges like cross-currency impacts or heavy, particularly GBP to US dollar is quite sharp. As well as the supply side is not like it is better than what it was in Q1, but still there are challenges on the ground. And so all these things, many factors play in at present. Other than that, the demand side is not completely reflective in the ground at present.
There's no contract deferment or cancellations that you're seeing just yet, but are you noticing any delays as far as client spending is concerned?
Not exactly, but no, there will be some contract, you will be in some contract, there will be some deferments or delays, something will be there, but the ground level, it's not that anything major is happening. If it is there continuously in one geography, a couple of customers come back and there is a deferment of it, then it will be more reflective on the situation. It's not there in the ground. However, we are reading the same economic data and same whatever you are reading, we are also seeing the same thing. What we believe this later part of the year or next year, probably there can be some kind of a slowdown maybe there for couple of quarters. However, the overall digital transition, what is happening is a completely cloud-based transition, which is a medium term, actually an opportunity for the IT companies, which we still believe that it's intact. There can be a couple of quarters of no demand slowdown in the next year, and it has not seen anything at present in the ground.
All right. Hi, Mr. Chakravarti. Good to hear there is no deferment. You're sounding, that things are not that bad, at least out there. And at least as of now, you're not seeing any big hit to business. So that's good news. So let's get to a couple of numbers then. Your international IT services business, that's the driver in terms of profitability. Now, the last couple of quarters, well, margins have seen a bit of a pullback. I believe you have taken already the wage hikes. So your employees will be pretty happy out there. Since that's behind you, what is the margin trajectory we should look at for your international IT services business, point number one? And also, what is the growth, the constant currency growth? I think the dollar revenue growth in the first quarter was around 2%. For the year, what can the number look like?
Yeah. Okay. First, regarding the margin, we have given guidance that last year, EBITDA without other income and forex was around 24.5%, and this year we expected between 20 to 22%. Considering the salary increase, wages, attrition, replacement, supply side issues, and also our investments in a lot of leadership investments what we have done during this current year. So this is the guidance. We maintain the guidance for the whole year. We don't give the whole year revenue guidance, However, we do with for the last quarter, you said 2% quarter on quarter, but on the constant currency, it was around 3.8% actually. So the ground level, we expect to do better than what we did last year.
Much better, sir. How much better, Mr. Chakravarti? The last time as well, you said you'll do better. How much better? Can you maintain this this kind of momentum? As you said, 3% I think constant currency is what you have done. 2% dollar revenue. Can you maintain this sort of a run rate?
Actually, we are not seeing any major negatives, hurdles coming forward at present. We have to see how it unfolds in the next few quarters. Overall, for the year, we expect the demand. We expected to do better than what we did last year. Last year, we did organically in high teens. Actually, we expected to do a little better than that this year.
So this
we are not giving guidance for this year.
Sure. But this margin guidance of 20 to 22% is much less than what you did not only in FY22, but also in this year. You had almost, actually in the last year, you had almost 30% margins at one point in time. When do you think you can come back to that range?
We have explained that because of the demand, supply side constraints and the salary increases and the attritions and all these things, there will be some cost increases, as well as we have done some investments for this year. We expected that there will be some, the recovery on the margin strength will start coming in from the next year, beginning of the next year.
So are you having more wage hikes in Q2 and Q3?
Not exactly. We have not planned any wage hike of it, but we have to be flexible and see what is the situation, how is that, attrition and supply side constraints happen. Maybe we will take some measures for pockets or set of people, depending on what is the current situation. We are more flexible to see and address the issues as it comes in.
Mr. Chakravarti, if you're not going to be giving, larger wage hikes, then you must be reasonably optimistic that peak attrition levels are behind you. Is that your understanding, or are we reading that correctly? I think in the first quarter, the annualized attrition level was around 24%. Has it peaked out? Will it start cooling off from here on?
We expected to. That's what it looks like for this current quarter. It is better than what it was in the last quarter. And Q4 to Q1, there was an improvement, and Q1 to Q2, we see there is an improvement in the attrition level. But we have to wait and see how this will emerge in the future quarters also, because with so much of impact happened on the supply side, we want to be a little cautious in making this kind of what is happening in the coming quarter. But it is better now compared to what it was last quarter.
Okay, all the best. We hope all your margin pressures and the challenges come to an end this year. It's been a tough time for your company. Well, that's Sonata Software. Devin Choksi is still sitting by. Devin, the stock is down 20% this year already, and the management is guiding for a lower margin range compared to what they've done last year. At one point they were sitting at 30%, and now they're saying they'll barely manage 20 to 22%. Do you think the worst of this is priced into the stock, or could there be more?
Yeah, Sonia. So I think for most of the mid-tier IT companies, I think this is going to be a situation wherein if they saw the better margins last year, I think this year is going to be challenging because the economy has opened up. It is all normal. And at the same time, some of the stronger headwinds, like I think the cost of manpower, the wage increase, and at the same time, I think the currency-related challenges that they would see. So all in all, put together, the margins for some of the mid-sized companies are going to be under pressure. That is given, and I think that validates my viewpoint. But some of the larger companies who have done, I think, the bigger contracts, they would be in a far better position to handle the situation compared to mid-tier companies, I think, who are slightly more vulnerable in a given situation. Either you are a very specialized company when you are a mid-sized company, then probably I think your case is very different. So likes of LTTS, likes of Tata Elxsi, then your case is very different, that you are basically protecting your margin at the same time when you are growing. But I think those companies which are, I think, more driven by the services, probably I think for them this challenge is going to be there. I do not know whether I think further downside it can be in the stock price, because if you look at the price earning ratio of the company, it is just barely around 18 times. So anything further going down, I think it could become literally more attractive than what it is currently. So one will have to wait and see. But my preference would remain with, I think, the companies which are having niche in this particular space and where the visibility is on the higher side as far as I think the business is concerned. That would be my preference to add the stock in portfolio.
I mean, obviously, Tata Elxsi is in a different league altogether. But for the others, there's clearly been some margin pressure, and that's reflected in the way the valuations have also adjusted and perhaps more reset is needed. We'll take a break on that note. Up next, Devan, stay on. We have more questions for you. We'll discuss market technicals after the break. Sudarshan Sukhani and Mitesh Thakkar will be joining us. Welcome back. Well, the setup this morning is on the wrong side. I mean, the Nifty is down about, SGX Nifty is down about 193 points. Sudarshan Sukhani and Mitesh Thakkar now joining us. Gentlemen, good morning. Sudarshan, today perhaps is the day the market's texture will be tested. Do you trust the recent move and buy the dip, or is there a different trade?
Good morning, Anuj. You're quite right. It's not just going to be tested. The chances are that for short-term traders, it's going to change also. Now the Nifty is very likely to open below 17,550, which was our support level, which was being raised day after day. I don't think below 550 for the day, we want to be a buyer. So this is not today. We are talking about today. This is not a buy on dips day. We just let it be. The chances are that we can see further slides during the day. So if at all a trader wants, then there is a trade intraday to sell on a rally and then cover by the time the market closes. Don't carry it. But certainly no buying today. The Bank Nifty is a different story. It's been an outperformer, but it's not worth buying that because the whole environment is subdued, but don't short sell it.
Okay, so don't short sell it, but for now don't buy it as well. Mitesh, good morning. Would you buy the dip?
Not immediately, Anuj. I think what we have done is that we've kind of hit the upper end of the range, 17,750, 17,800. And now we might actually test the lower end of the range. So maybe if we open, around 17,500, then I'll wait for another 70, 80 points around the 17,400, 420 mark is where I think some kind of buying can be explored. But that's again, once you look at the support coming into play, which I think it will do that. So I think the idea is that yes, if not immediately post the opening gap down, but maybe, if you see mild follow through, then sometime during the noon, you might want to buy if you are closer to 17,400, 420 zones, and then take a 50-point stop from there. But otherwise, this remains a market which is still broadly consolidating and therefore not yet giving any kind of directional bias in the short term. The medium-term chart still remains positive. In case you break below this 17,400 level, then you might actually retest the 17,200 zone as well, but that will still not disturb the medium-term trend.
Okay. What about individual stocks? Because, we have noticed that this month, there are a lot of names that have done well. Telecom is coming back into action in a big way. Bharti is up almost 5% in the last 10 days. NTPC, JSW Steel, so some of the laggards are back. So Darshan, what are you looking at for the day itself on the buy and sell side?
Sonia, today there's nothing really to buy. I mean, we can just add one stock just to keep it a little balanced. The markets are going to be in rough weather today. So I'm mainly short selling. Biocon is an intraday short. See, short selling should always be done intraday. Biocon is an intraday short. It's been in a steady downtrend. So that downtrend means that it's one of the weaker stocks. Keep a stop above 296. Concor is a short. Concor again has been making a very large distribution. That distribution is likely to break on the downside today, suggesting much lower levels to come. In intraday short with a stop above 675. Hero MotoCorp is my only buying idea. There's no need to rush into it. If markets stabilize, and there are so many ifs, then it's worth buying into. The initial stop is 28.27, but you'll have to adjust it according to market open and the point at which it stabilizes. And LTI again is an intraday short with a stop above 45.54. So not a very good day.
Okay, so Hero is conditional buy if the market stabilizes. Others, there are short ideas, 3 short ideas for Sudarshan. Concor is there, LTI is also there. Mitesh, what are you buying and selling?
Again, selling is easier because you will get a gap down and a lot of stocks will also see that breakdown continuing. But buying would be only, once we start getting past yesterday's high. So I have 2 buys and 2 sells. Bajaj Auto is on the sell side. It was a sell yesterday as well. Keep a stop at 39.76. Look for targets of 38.35. Britannia is a sell with a stop at 36.35 for targets of 35.40. On the buying side is Cipla. If it starts getting past 1,045, 1,046, which is only 6-7 points away from the yesterday's close, then buy with a stop below 1,030 for targets of 1,075. And Gas Authority is the other one. That's a buy if it gets past 93.5. Buy then with a stop at 91.8 for targets of 97.
Okay, well, those are some stock ideas. Let's do one thing. Let's take a quick break. We'll come back with the pre-opening rates. Also with us, we'll have Ashwin Patil, who is the auto analyst at LKP Security, to discuss the demand trends in the tyre companies. Remember, tyre companies have hit fresh 52-week highs. More on that in a bit.